Market volatility hits Wall Street as rate cut expectations shift. Imagine standing at the edge of a cliff, staring into a fog so thick you can't see more than a few feet ahead. That's the current state of Wall Street, where investors are grappling with conflicting signals from the Federal Reserve and mixed economic data. But here's where it gets tricky. The same data that might suggest slower growth is also hinting at stubborn inflation, leaving traders stuck between a rock and a hard place. Let's break it down. On Thursday, major U.S. stock indices closed lower, with the Dow Jones slipping 0.4%, the S&P 500 dropping 0.5%, and the Nasdaq mirroring that decline. This isn't just a random dip. It's a reflection of growing uncertainty about whether the Fed will continue its recent trend of cutting interest rates. And this is the part most people miss. Even as some sectors like energy, up 0.9%, and tech, a slim 0.03% gain, held their ground, the broader market was in retreat, signaling a lack of consensus on the economy's true health. The confusion stems from contradictory data. On one hand, initial jobless claims fell to 218,000, a seasonally adjusted number that suggests the labor market isn't collapsing. On the other, second quarter GDP growth was revised upward, showing unexpected resilience in consumer spending and business investment. Meanwhile, Fed officials are sending mixed messages. Chicago Fed President Austan Goolsbee recently warned against hasty rate cuts, emphasizing that inflation remains a threat. Yet just weeks ago, the Fed slashed rates by 25 basis points, its first cut since December, sparking speculation about further reductions. Now, investor confidence in another October cut has dropped from 92% to 83.4%, according to the CME FedWatch tool, a subtle but telling shift. So, what's fueling this tug-of-war? Consider the case of CarMax, the used car retailer whose stock plummeted 20.1% after reporting weaker than expected profits. Or Accenture, which saw shares fall 2.7% despite beating revenue forecasts. These examples highlight a broader trend. Even strong companies are struggling in an environment where investors are more cautious than ever. As one analyst put it, historically, we're at the high end of valuations. One big positive is it seems like the government is going to let big tech get bigger. But is that optimism justified, or are we setting up for a correction? The next few days could provide clarity or deepen the mystery. Investors are fixated on Friday's release of the Personal Consumption Expenditures (PCE) price index, the Fed's preferred inflation metric. If inflation remains stubbornly high, rate cuts could stall. If it cools, expect renewed bets on aggressive monetary easing. And don't forget the looming October jobs report, which will either confirm or challenge the Fed's narrative of a soft landing for the economy. Here's the real controversy. Should the Fed prioritize inflation control over labor market concerns? Stephen Miron, President Trump's new Fed appointee, argues for faster rate cuts, while Chair Jerome Powell insists on a balanced approach. This ideological split isn't just academic. It shapes the financial futures of millions. And now it's your turn to weigh in. Do you think the Fed is right to slow down, or should it cut rates more aggressively to protect jobs? Share your thoughts in the comments below. In the meantime, the stock market seesaw continues. Energy stocks rallied on oil price hopes, while Intel surged 8.9% after rumors of a potential partnership with Taiwan's semiconductor manufacturing company. On the Nasdaq, 3,502 stocks fell versus 1,166 that rose, a stark reminder of the market's fragility. As one trader mused, the data is confusing. It makes you question how much the Fed can or should cut rates again this year. In a world where every number feels like a loaded die, the only certainty is uncertainty.